One important thing which I look at while investing in stocks, or well, in that case analyzing the stock, is about the cash flow. If you see, many times the company may be profitable, they may be making good amount of profit, so the PE ratio may seem low, in the sense maybe the stock is priced less, the earnings is very high, so the price to earnings ratio can be seen as a lower value, and people often get misguided thinking that it's a value buy. But then if you see, you should look at the cash flow also. If the profits doesn't match its cash flow, the company will have no cushions when the times get hard. So it's all about poor cash flow conversion. So how to identify a company with poor cash flow conversion after you have found out a low PE stock? So rising debtor level is one thing which I look at. So this is like the revenue is booked, the company is having a good revenue, but then it is not having actual cash collection. In the sense, the company is getting a lot of orders, he is executing the order also, but he is not getting enough cash flow, or he is unable to collect cash from the customer for which he has supplied the material to the customer. So this is like poor cash flow collection. The project execution team may be bad, or even you may be having some liquidated damage LD or some issues with the customer wherein customer is not paying you the full amount. So due to this poor cash flow collection, cash flow of the company goes down even if you are having high revenue, because once you have a good revenue, you show the profits based on that revenue. But in accounting terms, as soon as you get the order, it is shown in the revenue, and then your expenses, everything taken out of it after interest and amortization and depreciation, you show the PAT. So this PAT may not be in their books because the company may not have collected the cash yet from the customer. So if you don't have a proper cash and hence a free cash flow, there is no point of having that order from the customer. So another issue which I look at is cash flow from operation to EBITDA. So if that value is very low, then it shows that the profits are shown high, but the cash flow from operations is not there. So cash flow from operations CFO to EBITDA, EBITDA. So this ratio, if it is very low, it's again a red flag. Again, stretched payables. So the company is unable to pay to his vendors because of the poor cash collection from the customer. So he don't have cash to pay his vendor or for the raw materials. So the payables in the balance sheet also is something which I look at. If it is accumulating, it's again a red flag. High working capital requirement. This is also seen as draining cash despite growing profits. So high working capital requirement also to be considered with a pinch of salt, wherein you have to deep dive and see whether the company is having real cash collection or real cash flow. If just profits are shown in the form of earnings per share and a low PE, it doesn't mean that the company is having good cash collection. And if it is having a high working capital requirement, again it's a problem for the company. Also the other thing is that overstated earnings due to aggressive revenue recognition. So as I told, they bag the order at lower cost with low margins, and then they are unable to execute it at a proper cost. On the balance sheet they may show higher earnings. So the overstated earnings based on higher projected revenue is also one important thing which you should look at while analyzing the stock. Now you know that a lower PE doesn't mean that the stock is cheap. There may be underlying issues, especially for cash collection or lack of generating free cash flow. So do analyze this before getting into a stock. Stay invested. Till then, happy investing.